Well, it's logical if you think about interest rates. You take away the interest rates, a whole different game. But the interest rates around the world are low, low, low. And the central banks keep saying we're going to keep doing this and we're going to print more money and we're going to create more reserves and we're the only game in town. And when you take interest rates so low, all asset prices rise. Real estate, we are getting a recovery, stocks, precious metals, art, you name it, if it has a price attached to it, it's got an upward bias, and that includes the stock market.
But are stocks overvalued? If you look at earnings, revenue growth.
I hear this all the time. Look at the PEs. With slow growth economy, where are the earnings going to come from? Valid questions. But when you ask them, do you ask them in the context of an interest rate that's zero? There's a thing we call the equity risk premium. It's a very conventional, acceptable way to value stocks. If the interest rate is zero, the equity risk premium is infinity. It means you could buy stocks forever. Now we know you can't do that. But that low interest rate distorts traditional valuations. The second piece is we're going to have it for a while longer. So fighting it doesn't work. Moving away from it down the road, years from now, when the time comes, is another matter. That's the time to get off the stock market, not today.
So what do you like in the stock market then?
Well, I'm an ETF manager. So we use separate accounts, so we use broad-based ETFs. We think the market has an upward bias, so we want to broaden it out. We don't want to narrow it in on the big caps only. For example, RSP, the symbol RSP, gets you an ETF of the S&P 500 index equal weighted. SPY gets it for you cap weighted. When the market's broadening and rising, you want the equal weighted version, not the cap weighted version.
Do you like anything outside the U.S.?
Yes. I like Japan. Change in policy. It's a game changer worldwide. And we now have a large position in an ETF. The symbol is DXJ. It's a wisdom tree ETF that is hedged for the currency weakness and gets you into the Japanese stock market. Rising stock market, local currency terms, translated without the currency risk. And we're very excited. It's been a great position so far.
Anything else interest you on the equity side?
On the equity side, well, the energy sector is now a question because we've had a great play. Gasoline prices may be peaking. So in the short run, it may pull back. In the long run, the exploration, pipeline, development, energy sector in the United States is a winner. We are approaching an 8 million barrel a day oil production. The Saudis are at 9. Can you imagine? We may pass Saudi Arabia as an oil producer. What happened to all the peak oil guys that said the world's coming to an end? You can't get them in here to interview anymore.
When you move away from equities, you mentioned some other assets rising, whether it's real estate or art or something that commodities might be another one. Outside of equities, what's interesting to you? Where is their value?
Great value in the good quality, you got to do the research, tax-free bond in the United States. The tax rates are higher. The credits selectively are improving because the economy is recovering, not deteriorating. And the valuation has not changed in the market because of this overhang question about politics in Washington are going to cram down the benefit of the tax-free bond by capping at a tax rate of 28% when the rate is now above 40. I don't see how a retroactive tax on $3.7 trillion worth of tax-free bonds issued by every county, school board, hospital, airport in the country will be imposed by the Congress, and if it is, it'll go to the U.S. Supreme Court. So the Obama plan to retroactively tax tax-free bonds is very unlikely to happen. That means every tax-free bond in existence is cheap unless that law passes. And if it doesn't pass, they will all soar in value.